Beneath Florida's glittering sun and swaying palms, a silent, unseen disaster is brewing. The paradise that once promised endless ocean views and suburban serenity is now teetering on the edge of a full-blown housing collapse. As 2025 relentlessly unfolds, thousands of brand-new homes, once gleaming symbols of prosperity, now sit eerily vacant. Home values are plummeting by tens of thousands of dollars, with some cities seeing drops exceeding 15%. This is a brutal one-two punch of relentlessly rising mortgage rates and skyrocketing insurance costs that is utterly hammering affordability for countless families. Builders are openly panicking, slashing prices, and offering incentives that were once unthinkable, like $25,000 off just to move inventory. But it's not working. Incomes simply can't keep up with the crushing weight of $3,200 mortgage payments and $6,000 insurance premiums. The Florida dream is fracturing. Welcome to the Sunshine State's darkest secret. These aren't just any cities. These are the 10 fastest collapsing housing markets in Florida, where the dream of paradise is slipping away faster than ever before.
Number 10. Miami. Once the shining star of Florida's luxury condo boom, Miami is now caught in a storm of collapsing demand, skyrocketing costs, and widespread investor retreat. While the skyline still glitters with high-rises, many units are now sitting eerily empty or unsold. As of 2025, the average condo in Miami carries a relentless HOA fee between $700 and $1,500 a month, with some high-end buildings hitting a jaw-dropping $2,800 monthly. And that's before the brutal multi-thousand-dollar special assessments, which can add $50,000 to $100,000 per unit, especially in older oceanfront towers requiring structural upgrades post-Surfside. The median condo sale price in Miami has fallen from $520,000 in 2022 to around $450,000 in mid-2025. But price is only part of the story. Inventory has ballooned. Over 30% more condos are languishing on the market compared to last year, and many owners are delisting out of sheer frustration. Financing has become another insurmountable hurdle. Lenders are increasingly refusing to fund units in buildings with high deferred maintenance or litigation risk. Cash buyers once flooded Miami, but foreign investment has cooled. Many are now dumping units due to insurance costs doubling and stricter disclosure laws. Even in trendy neighborhoods like Brickell or Edgewater, buyers are more cautious than ever. Units in aging buildings from the 1970s and 1980s are hardest hit, many of which now require multi-million-dollar repairs that HOA boards can no longer delay. In a city built on luxury and image, the cracks beneath the surface are becoming impossible to ignore. With thousands of units overpriced, overassessed, and over-leveraged, Miami's condo market is now a bubble deflating under the immense pressure of its own ambition. Number 9. Jacksonville. Our next warning sign at number 9 is Jacksonville. The largest city by land area in the continental U.S., it saw massive housing gains between 2020 and 2022. But in 2025, the story has dramatically shifted from relentless boom to a chilling, undeniable slowdown. The median home price in Jacksonville has dropped from its mid-2022 high of $410,000 to around $357,000, representing a brutal fall of $53,000, or nearly 13%. What's relentlessly causing this sharp downturn? It's a devastating mix of higher borrowing costs, pervasive overbuilding, and a dramatic, unprecedented rise in housing inventory. In 2021, Jacksonville had fewer than 4,500 active listings. Today, that number has horrifyingly approached 9,000, representing an increase of over 100%. Homes that used to vanish within 10 days now painfully linger for 40 to 60 days, and many desperate sellers are cutting prices or offering significant cash toward closing just to attract any buyers. The overwhelming oversupply, particularly in fast-growing suburbs like Middleburg and Oakleaf, is mercilessly putting downward pressure on prices across the entire metro area.
Homeowners now pay an average of $4,200 annually for coverage, a brutal leap from just $2,100 in 2021. Property taxes have also climbed relentlessly as assessments catch up with the pandemic-era price hikes, pushing average tax bills to around $3,800. The affordability crisis is deepening. At a 7% mortgage rate, a $357,000 home now commands a monthly payment over $2,500 for principal and interest. That's a monumental leap for a city where the median household income sits around $63,000. Jacksonville still offers economic diversity and job growth, but its housing market is clearly in painful correction mode. Rising inventory, crushing affordability pressures, and relentlessly costly overhead are reshaping what was once a pandemic-era housing winner into a cautionary tale.
Number 8. Tampa. At number 8, we turn our urgent attention to Tampa. This city was once the rock star of Florida's real estate scene, fast-growing, full of jobs, and absolutely booming in the early 2020s. Its rapid ascent, fueled by an intoxicating mix of genuine growth and heavy investment, marked it as a significant early flashpoint where a dangerous housing bubble began to dangerously inflate. Between 2021 and 2022, this Gulf Coast hotspot became a magnet for remote workers, retirees, and crucially, Wall Street-backed investors chasing sunshine and profits. This insatiable demand pushed average home prices to $383,410 in 2022, creating unsustainable price appreciation that far outpaced local wage growth. The frenzied bidding wars were a clear symptom of the bubble's formation. If you're finding this crucial information for understanding Florida's market shifts, please gently hit that subscribe button to Discover the Nation. Your support powers our in-depth investigations. But in 2025, that glow has faded fast. Prices have dipped to $360,130. The red flag waving hardest is exploding housing inventory, up more than 55% since last year. Homes that once sold in under 2 weeks are now sitting for 75 to 90 days. The short-term rental market is crushed, with thousands of Airbnb landlords flooding the resale market. And then there's the critical issue of buyer financing, with mortgage rates hovering around 7.5%, pricing out buyers. Tampa's aggressive growth, once its strength, has left it with overvaluation and oversupply, the very hallmarks of a bubble now beginning to burst. Without a drastic shift in buyer confidence or interest rates, Tampa might be on track to become one of the biggest housing correction stories in Florida.
Number 7. Sarasota. Known for its white sand beaches, vibrant art scene, and a sophisticated retiree population, Sarasota became a prime magnet for high-end investment and second home purchases. Its rapid price appreciation and overvaluation, fueled by affluent buyers, marked it as a key flashpoint where Florida's housing bubble truly began to inflate in the luxury segment. Sarasota's market overheated rapidly, driven by out-of-state wealth seeking paradise and speculative gains. It was labeled one of the most overvalued metros in Florida, peaking at 38% over fair market value in 2022. This aggressive upward trajectory, detached from local economic fundamentals, was a clear symptom of the bubble's formation. Now the balloon is popped. Inventory has soared to levels not seen since 2015, with over 3,700 homes listed for sale, putting serious pressure on prices. Homes that were once fetching $1.2 million are now struggling to move at $975,000, representing a colossal 18.75% drop and signaling widespread financial distress. Buyers are tightening wallets, and mortgage rates topping 6.75% mean the luxury home crowd is getting pickier or disappearing. Add in crippling insurance premiums, $8,000 to $10,000 plus annually for waterfront homes, and the true cost of ownership is unbearable. Sarasota's market, once riding high on speculative luxury, is now in painful correction, its overvaluation a stark reminder of where the bubble truly took hold. This market's current state highlights the extreme vulnerability of high-end, amenity-driven areas to rising costs and shifts in global wealth, making it one of Florida's fastest collapsing markets. Number 6. Fort Lauderdale. This city, celebrated as the Venice of America with its stunning beaches, intricate canals, and world-class yachting industry, grew at an incredible pace, epitomizing the luxury coastal boom that significantly contributed to Florida's broader housing bubble. Its rapid price explosion, fueled by high net worth migration and investment, was an early warning sign of truly unsustainable growth. Fort Lauderdale's boom was overwhelmingly driven by wealthy out-of-state buyers, foreign investors, and remote workers chasing an aspirational lifestyle and perceived exclusive value. Home prices exploded to a median of $680,000 in 2022, utterly detaching from local incomes and fundamental value. This created a strong pull for developers to rapidly expand, pushing ever higher with luxury condos and beachfront properties. Now, the engine is stalling. Buyer demand from even affluent out-of-state and international sources has significantly cooled. Inventory, particularly in the luxury condo and waterfront segments, is spiking. Prices are sliding back down to an estimated $555,000, a $125,000 drop or nearly 18.4% from its peak. This coastal paradise was simply never meant to sustain such inflated valuations, and the financial foundation is cracking, a direct result of the bubble's expansion. The skyrocketing coastal insurance costs, driven by increasing hurricane risks, now often top $10,000 to $15,000 annually, adding immense pain for homeowners. Furthermore, the specter of massive condo special assessments brought on by new safety regulations is creating financial nightmares for owners of older buildings, making many units virtually unsellable. Fort Lauderdale's rapid, speculation-driven growth was a clear symptom of the bubble's beginning, and it's now experiencing a hard reset that's hitting hard at the high end, making it a critical market to watch for further declines.
Number 5. Orlando. Halting our countdown at number 5, we examine Orlando. Orlando, the land of theme parks and sunshine dreams, is suddenly waking up to a sobering, inescapable housing market reality. Between 2020 and 2022, Orlando's median home price soared from $280,000 to $415,000, a jaw-dropping 48% increase. But in 2025, that magic bubble is grimly deflating. Median prices now sit around $375,000, a $40,000 dip, or nearly 10% from the peak. And analysts grimly warn the slide may not be over. Part of Orlando's problem is catastrophic overbuilding. The city recklessly issued over 17,000 residential permits in 2021 and 2022 alone. Now, many of those newly constructed homes are tragically flooding the market. Active listings have ballooned from 4,200 to over 9,000 in just 24 months, an alarming surge. Days on market have more than doubled from 18 days in 2022 to over 45 days in 2025. Sellers are desperately offering mortgage rate buydowns, closing cost coverage, and even theme park passes just to stand out in a flooded market. Interest rates around 7% have brutally hammered affordability. A $375,000 home now commands monthly payments around $2,500 for principal and interest, a brutal leap from $1,500 just a few years ago. Property taxes now average over $4,200 per year, and insurance premiums, especially in hurricane-prone zones, have climbed past $5,000 annually, adding immense financial strain. Orlando's rental market is also conspicuously losing steam. Monthly rents have dropped from $2,250 in early 2023 to about $1,975 in mid-2025, a 12% decline. Household incomes average $61,000, yet basic mortgage payments now consume nearly 50% of take-home pay. That's simply not sustainable. For now, Orlando still shines for tourists. But for homeowners and landlords, the city's real estate market is revealing some very real and painful cracks behind the magic.
Number 4. Palm Bay. Palm Bay isn't flashy like Miami or Tampa. It's a quiet city on Florida's East Coast, best known for being affordable, until it tragically wasn't. Between 2020 and 2022, Palm Bay's median home price jumped from $190,000 to $370,000, a shocking 95% increase. That explosive boom was recklessly fueled by pandemic migration, transient remote workers, and aggressive flippers desperate to make a quick buck in a once sleepy market. But in 2025, Palm Bay's inevitable crash is quietly becoming one of Florida's worst, threatening to hollow out entire communities. The warning signs are omnipresent. Inventory has exploded, and vicious price cuts have become the chilling standard. Homes listed at $400,000 last year are now being savagely slashed to $300,000 or less and still sitting conspicuously empty. Builders continue flooding the market with new homes, offering desperate incentives like $20,000 discounts and interest rate buydowns, further dragging resale values into the abyss. Palm Bay's biggest vulnerability is its dependence on fleeting speculative demand. Most buyers during the boom weren't locals. They were remote workers, cash buyers, and retirees, foolishly betting on long-term growth. But now those buyers have vanished, and many are frantically trying to offload their properties before prices sink even further. With interest rates stubbornly stuck above 7%, the average monthly payment on a median-priced home exceeds $2,800, a sum far above what the majority of local families can manage. And, unlike Miami or Orlando, Palm Bay tragically lacks a deep, diversified employment base to prop up prices. It may not grab national headlines, but Palm Bay is quietly sinking into the financial quicksand of Florida's housing bust, one painful price cut at a time, leaving behind a stark landscape of regret.
Number 3. Winter Haven. Winter Haven, a quiet central Florida city known for its chain of lakes and retirement-friendly atmosphere, is now facing a condo collapse that few saw coming. Once a hidden gem for snowbirds and retirees seeking affordability, the condo market here is unraveling due to skyrocketing HOA fees, structural repair costs, and rapidly declining demand. In 2022, the median condo price in Winter Haven hovered around $185,000, but in 2025, it slipped to nearly $158,000, a 15% drop. That may seem modest compared to coastal cities, but in a market where most buyers are on fixed incomes, the impact is massive. Many retirees are walking away from units because they simply can't afford the new dues. HOA fees that were once $175 to $250 per month have ballooned to $400 to $600 per month, with many communities also announcing special assessments between $10,000 and $35,000 per unit for roofing, stucco repair, or reserve fund replenishment. The Surfside legislation now requires mandatory reserve funding by 2025, and Winter Haven's older condos, many built in the 1970s and 1980s, are scrambling to comply. If you're finding this crucial analysis of America's collapsing markets vital for your understanding, please gently hit that subscribe button to discover the nation. Your support helps us bring you more vital insights like this. Listings have surged by 40% year over year, and the average days on market now exceed 80 days. Winter Haven's condo crisis is a cautionary tale. A once affordable retirement haven is becoming unaffordable due to hidden fees, poor long-term maintenance planning, and state-level reforms catching up with aging buildings. For many, the dream is turning into a financial nightmare.
Number 2. Crestview. Crestview, a small city tucked into Florida's panhandle, may not make national headlines, but its housing market crash is proving to be one of the most severe in the entire state. Between 2020 and 2022, Crestview saw home prices skyrocket from $215,000 to nearly $310,000, an astonishing 44% surge fueled by its perceived affordability. But in 2025, that reckless momentum has horrifyingly flipped. Median prices have fallen to about $268,000, a $42,000 drop, or a 13.5% decline in just a couple of years. Part of Crestview's initial appeal was its affordability for military families stationed at nearby Eglin Air Force Base, along with remote workers seeking lower prices and a slower pace of life. But rapidly rising mortgage rates have utterly decimated affordability.
At 7%, a $268,000 mortgage costs over $1,900 a month for principal and interest, compared to just $1,150 a month at 3%. A staggering 65% increase for a city where median household income sits at $61,000. That brutal shift is massive. Inventory has nearly tripled. In 2022, there were fewer than 400 homes on the market. Now Crestview has over 1,100 active listings, with many homes sitting unsold for 60-plus days. Builders caught flat-footed by the downturn are cutting prices aggressively, some by as much as $30,000 to $50,000. Price cuts are now standard, not rare. Insurance is another devastating hit. While rates here aren't as high as coastal Florida, they've still doubled from $1,500 annually in 2020 to more than $3,000 in 2025. Property taxes have also climbed, averaging nearly $2,800 annually on modest homes. Combined with utility increases and relentless inflation, many families are simply priced out. Rents have dropped as well. Crestview's quiet charm remains, but beneath the surface, its housing market is in profound crisis, driven by affordability shock, pervasive overbuilding, and economic fragility.
Number 1. Northport. Finally, at number 1, we have Northport. Northport has tragically taken the unfortunate crown as Florida's most rapidly collapsing housing market in 2025. Located in Sarasota County, this city saw some of the most explosive growth during the pandemic. In 2020, the median home price was just $260,000. By mid-2022, it soared to an eye-watering $450,000, a monumental 73% jump. But that reckless boom has turned into an undeniable bust, signaling widespread devastation. As of 2025, the median home price in Northport has plummeted to just $377,000, representing a staggering $73,000 drop, or 16.2%, making it the biggest year-over-year decline in the state. Why this devastating crash? Overbuilding is a key culprit. From 2021 to 2023, developers foolishly flooded the market with thousands of new single-family homes, expecting demand to remain red-hot. Instead, inventory exploded. Active listings have skyrocketed from under 900 in early 2022 to over 2,300 in mid-2025, up 156%. Homes that once sold in 7 days now painfully linger for 70 or more. New builds are now routinely discounted by $40,000 to $60,000, and builders are even covering closing costs to avoid further price slashing. A $377,000 mortgage now demands nearly $2,650 per month, up from $1,500 per month at pandemic-era rates, a brutal increase. Insurance premiums have also surged from about $2,200 in 2020 to more than $5,800 in 2025, thanks to heightened hurricane risk and remapping of flood zones. Add in $4,200 in property taxes, and Northport's once affordable dream is actively breaking household budgets. The rental market is showing signs of stress too. Rents peaked at $2,350 in 2023, but have fallen to $2,050 by mid-2025. With job growth slowing and buyers retreating, landlords are struggling to maintain margins. Northport's fall from grace highlights the danger of unsustainable growth. Once seen as Florida's next big boomtown, it's now ground zero for the state's housing market correction. If any city shows how fast fortunes can change and how devastating a collapse can be, it's Northport.
The message is clear. Florida's real estate landscape is shifting dramatically. Stay informed, stay vigilant. Its beaches still call, its skies are still blue, but beneath the sunshine, the cracks are showing, especially in the housing market. From Lakeland to Cape Coral, from once booming suburbs to fast-growing cities, buyers are waking up to a new reality. The same homes that soared in price just 2 years ago are now sinking. This isn't just a slowdown, it's a reckoning. Overbuilding, inflated pricing, sky-high insurance, and shaky rental returns have left many Floridians and hopeful newcomers holding the bag. And in some cities, that bag is full of falling equity and rising regret. The American dream didn't disappear here, but it did get distorted. So if you're looking to buy in Florida, be cautious, be informed, be strategic. Not every palm tree hides a paradise. Some are planted in markets that won't recover for years. Don't forget to like this video, share it with anyone who needs to see this vital information, and of course, hit that subscribe button for more in-depth analyses from Discover the Nation. We'll see you in the next video. Because sometimes, knowing where not to buy can be the best investment decision of all.